So today I have the privilege of talking to Steven Van Metre. He writes a regular column for the Epoch Times, or maybe it's irregular now, and he has an insanely popular YouTube channel, but everybody who watches Real Vision will be familiar with him. Hi, Steve. How's it going?
Oh, I'm doing great, Harry. It's a real pleasure to speak with you today.
Well, we'll see about that, won't we? So when we set this discussion up, I think the idea was to discuss portfolio construction, which is probably the element of investment management that the general public understands least well. I can certainly imagine a bunch of my old colleagues raising an eyebrow to see me discussing portfolio construction, because it certainly wasn't what I was strongest at. Um, Talk to us about portfolio construction and your thoughts on portfolios at this point in time in this market environment.
Yeah, I think the thing that I find most interesting right now is talking about portfolio hedging, and that's something a lot of people struggle with because you think about what is portfolio hedging. When I get in my car, well, it's got an airbag, it's got anti-lock brakes, and probably 1,000 other safety features, some of which I don't even know what they are. And you start thinking about all that extra weight. What does it do? Well, it's a drag on performance. So you have to put a bigger engine in the car to keep up, with what may have been a car in the 80s and when I was a kid that you would drive that were much smaller, much lighter weight. And you start to get this view when it comes to managing portfolios is, well, why would I hire someone, like you or someone in your industry, because you're going to try to control risk when I could just buy one of the major indices and I don't have to worry about that. And I think you and I were talking about that the other day is it seems all well and good up until things go wrong. And that's the same thing with the safety features. I could take a car from the 70s or 80s, get in the same accident I could get in with a modern car today. And there's a good chance in today's vehicle, I walk away. In one of those, I might not.
No, it's absolutely true. If you take a portfolio which is the market, you will have the market's performance. And the market's been great the last 5 years, give or take one disease pandemic problem. If you're long in March, you were probably blinking and double taking your 401k statement. But that you'll have the market sharp, you'll have the market's return, and the market's vol, and that's for good or ill. And sometimes ill, right?
Yeah, because what we were talking about before is if you look in a down market, that's where indexing fails. We can kind of look at the research from guys like Mike Green, who are just absolute experts in that space, to say, look, who knows when this thing goes, it could go real deep as more people start to sell. And we kind of were joking about it the other day, but it wasn't really a joke when we said, look, the goal, when you're a money manager and you're trying to control risk, is just to lose less in a bear market than everyone else. And when people hear that, they have to be like, well, wait a minute, that doesn't make any sense. Well, it does, because if you're the type of person that can make money in an up market and a down market, and you're not a hedge fund manager, you're in the wrong job. Because it's really hard. And in a bear market, you think about, look, if you can just come out of that car wreck in one piece where everyone else is, being hauled off to the hospital, you won. Because if you've played the game right and you've hedged your portfolio, what it means is your hedges have actually gone up in value. You can sell those hedges and buy risk assets at the bottom. And if you can do that long term, you're going to outperform the broad equity market all the time.
So I love the idea of having a convex portfolio, or something which will outperform on the way down and hopefully outperform on the way up as well. Easier said than done. Usually there's a price for that convexity, and the price is losing some performance somewhere along the line. But how would you approach it in these markets? What exactly does it mean to hedge in this environment?
Yeah, so that's a good question. So for me, I love the bond market. I think long-term treasuries remain one of the best mechanisms to hedge out there. Some people like cash. I think there's no opportunity cost in cash, which it could go either way, because the last 2 years, if you've been hedged at all with bonds, well, you've underperformed. Whereas cash, you wouldn't have seen that sort of drawdown. What I like about bonds is during recessions, what we see is interest rates go down, bond prices go up, and that's the big opportunity for me. even though a lot of people today look at the system, they look at the bond market over the last few years and say, nah, Steve, it's not how the system works. It's like, no, it is still how the system works. We have some wonderful experts that have been on Real Vision in no particular order. We have Dr. Lacey Hunt, Jeff Snyder. I mean, these guys know the plumbing of the system better than anyone. And when those guys are telling you, look, if you understand how the system works and you follow their research, you really start to understand that there's a reason why interest rates fall during recessions. And so if you're hedging, of course, timing is a big issue. I think we could even talk about that, Harry, being, hedging too soon or even too late could be a problem. But what I look for is what is something I could put some money in. I don't have to dedicate a large portion of the portfolio because I don't want to. If I put half of my portfolio in a hedge, I mean, now I'm really underperforming, but I need to be able to put, maybe 15, 20%, scale that up when risk goes really off. But the key is I need something that has a high probability chance of going up a bunch so I can offset those losses on the other side of the portfolio and then again, release them back by selling that hedge later and buying back into risk assets.
I see what you mean. Generally speaking, in recessions, bonds outperform. But we started off very close to zero yields. Yields were exceptionally low, I should say. The front end of the curve, Fed rates were zero. Further out the curve, they were compressed because of a balance sheet expansion. Given 8% inflation, it's not so weird that bonds have been selling and selling and selling and selling ever since the Fed said, you know what, maybe we should raise rates. Why won't these bonds continue to sell off? Why is now the time?
Well, I think this is where we can look to the research from Dr. Milton Friedman. And what we learned from him is pretty much the opposite of conventional thinking, where interest rates rise actually in response to periods of loose monetary policy. And so what typically happens going into recessions, what do you see the Fed do? Well, they're tightening, they're raising rates, or they're doing something called quantitative tightening, which a lot of people actually, which I find interesting, associate with higher interest rates. And they say, well, if the Fed's going to sell bonds from their portfolio, well, then rates must rise because, well, who wants that junk? Well, that's not how the system works. It doesn't matter if the Fed's selling or everyone else is selling. What happens is in periods of tight financial conditions, interest rates have to fall. And you start to think about, why does that happen? And that's one of the things that I challenge people watching this is, if you're just shallow, kind of digging with a little shovel, just flipping some dirt over, really start to dig deep and challenge. Be like a little kid and who looks up at their parents and says, well, why is the sky blue? Why is this way? Because when you start challenging the normal way of thinking, well, you really start to get into some deep answers. And you start to realize that the way our financial system works is when the Fed tightens, they're trying to slow down the growth of money. They're trying to slow down credit creation. And in a debt-based economy, you need this influx of new money into the financial system. Well, how is money created? That's the next question. Well, okay, how does that happen? Well, it's not created by the Fed. It's created when people go and borrow from the commercial banking system. So new money is created as new lending is originated. Well, what happens during recessions is you get this deceleration of the money supply, the Fed's contracting credit, and all of a sudden the system starts to crumple in on itself. And in order for new money to be created, what has to happen? Well, if rates go higher, then people don't want to borrow. At least that's generally what we see. Now, there are cases we could go to the 70s and we could say, okay, that happened, and maybe we could ask why. But why do we see rates fall? Well, they have to fall enough where people are willing to go out and borrow again. And that's kind of the key. The monetary system just kind of naturally, think of it as a living, breathing organism, and it understands that. It says, look, things are going to get worse unless new money's created. So rates have to fall. Doesn't matter who's selling them. And so that's kind of one of the reasons why I really find the bond market particularly interesting as a hedge.
I was intrigued that you raised the subject to the 70s because the reason underlying the continued selling of bonds to this point, I mean, we're kind of at the highs in yields. And it's not, I was running with myself with a long bond position until Monday. I put it on relatively recently, but I lost money on it and I cut it. And the thesis that bothers me is the possibility that inflation actually remains higher than expected for longer than expected. And if right now we have real yields, if inflation is 8% roughly speaking, and yields are actually like 3% roughly speaking across most of the curve, that's -5 in real yields. I should be borrowing money if I could find something productive to do with it. So if we're looking at real yields, policy is still too accommodative. Why would that turn?
Yeah, and so you look back to this. Let's go back to the 70s, right? Why really did we see a lot of what happened? Is it a demographic issue? Sure, that was an absolute factor. But when you really start looking into the monetary system, one thing I noticed is there was a large number of commercial banks relative to where there is now. And I mean, quite a large number of them. So when you think about, you know, people borrowing money and money being created, is I could borrow from one commercial bank and I could pay you, Harry, for say a service that you provided, and you deposit that in another commercial bank, which could then be borrowed against it. So you have just a lot of money creation. But if I borrow money from a commercial bank to pay you for a service and you actually bank at that same bank, well, the money's not moving anywhere. It's not going anywhere. It's coming right back to where it was created. And maybe you're paying off the debt at that bank. And so now all of a sudden we're kind of netted out where nothing really happened. So you saw back then a lot of commercial banks, which are key to really creating money growth. You saw velocity was relatively high. And then I could go to someone like my dad who was working back then, and he says, yeah, during the inflationary times, it was not unusual where, every month or maybe every pay period, I actually got a raise. And he says employers were really driving, wage increases back then. Today, you don't really see that factor. We have very few commercial banks, very low velocity of money. And so back in the 70s, people had a better chance at affording higher prices, whereas today, in fact, in the news today, we see where Target has this inventory problem. Well, if there's all this money and people are so flush with cash, why are they having an inventory issue? Well, the reality is people cannot afford higher prices. So whereas in the 70s, we saw this different relationship, today, when you see periods of high inflation, they tend to get rejected because people can't afford them. Wages aren't that high. And as inflation comes down, we know that as growth falls and inflation falls, well, that means yields are coming down as well.
So if you're arguing, I would agree that the competitive position of labor is much weaker today than it was in the 70s, that it's harder for workers to force pay rises. Although you are starting to see, I see headlines that I don't see the fact that this trend hasn't matured, but I'm starting to see more unionization, or a fight to achieve unionization. I'm starting to see labor pushing back because high inflation is reducing living standards. Everybody, well, pretty much everybody except for those who walk around in New York City, know where gas prices are. They know what's happening to their consumable basket. So one observation is maybe that's starting to change. Another observation would be we can distinguish between cost push and demand pull inflation. The Fed doesn't really do much to affect cost push. There's not much it can really do. If you need to build new diesel refineries to get diesel prices lower. The problem in diesel, and nobody talks about this because it's unpatriotic, but I'm an idiot, so I'll talk about it, is that Russia was an enormous producer of hydrocarbons, in particular refined product in the Eurozone. So when they cut Russia off, it created logistical problems of getting enough diesel in Europe. And North American diesel, some of it is being exported to Europe, so we don't have enough diesel in this country now. You should see what the price of it looks like over there. These cost push pressures, they ain't going away tomorrow, are they? They're still going to be here in 6 months' time because no one's building a new diesel refinery.
Right, but that's not monetary inflation. That's supply chain inflation. So that's a whole different ballgame. And so if the notion that high prices have to lead to high interest rates, which is a predominant view that I love to challenge, because I'll give you a perfect example, Harry. I recently sold my house, and timing may be very good about that.
Yeah.
But when I met with my realtor to price it, there was never, he didn't say, look, Steve, depending on where you price it at, the buyer is going to have to pay a higher interest cost. So we should look at these different brackets. You don't see that play out in the real world. When I, if I went down to a car dealership and I said, show me the financing rate on the cheapest car you have and the most expensive car you have. In fact, maybe the interest cost on the most expensive car in terms of the rate might actually be lower. So this notion that as prices go higher, people have to pay a higher interest cost, we just don't actually see that too often. And yet the market's response is, well, prices are going up, doesn't matter why, people have to pay more. Well, as the Fed decelerates the money supply and wages don't keep up with inflation, it makes it even worse. And that's kind of the other side that we're seeing here is inflation-adjusted wages are actually negative, and they've been negative now for, 6 months, maybe a little bit longer. So it's like, great, you put higher interest costs on top of the consumer who's already strapped, and they're not going to borrow. And we start to see that happen over and over again. And what we notice is that higher interest rates get rejected. And I think that's a key point that I like to bring up to people is if you think rates can continue to rise, well, look at refinance applications. But in what's notable, as refinance applications at the major commercial banks drop and get to really low levels, well, what happens is rates eventually start to go down because you look at what is the product of a bank? Well, it's lending. We think of it as simple as, well, if I go to an ice cream store, right, the product is an ice cream cone. Well, we don't think of when we go to a bank, it's a loan. So if rates are going up and people are rejecting them, then what's going to happen to the bank? They're going to go out of business. Well, not necessarily, because if you start to understand the dynamic of the banking system, it's pretty interesting. As a new deposit comes into a commercial bank, however it shows up, doesn't matter. What does a bank do with that deposit? Well, they have to pay interest to the depositor. Mm-hmm. I mean, that's what now we could make jokes about not getting much right now, but they still have to pay me interest. So how do they get the interest? Or do they just print it out of thin air? They don't. They either have to take my deposit and lend it out, providing there's demand, which is where they make most of their money, or they have to go buy an interest-bearing deposit, which, as we now know, is a U.S. Treasury or a mortgage-backed security. Mm-hmm. So if on one hand your lending is coming down, then your bond purchasing is going up. So in effect, for people to really quantify this, if you've ever gotten a mortgage and the mortgage lender said, would you like to buy down your rate and give us some extra money? Well, effectively, the commercial banking system can buy down rates by purchasing longer duration bonds, driving rates down, and then selling those bonds later. And we see that every time. So what's neat is right now, refinance applications are very low, and we're starting to notice that there's similarly a bottom going on in bond prices, a peak in interest rates.
The counter argument is, so broadly, I sort of agree with what you're saying. It's just that timing is everything in this. And I can, right now, the reason why the bonds have been soft is because they are seeing interest rate hikes telegraphed by the Fed. The Fed takes responsibility, or at least has some responsibility, for the level of inflation. And you're right, the thing may just tail off. I mean, already beta effects have gone negative. So inflation should start to drop. The curious thing is that it hasn't dropped faster. Right. And I think I know why that is. I think we have these supply side effects, which are one-offs. And those supply side effects are affecting the energy complex. They're affecting the metals complexes. They're affecting food complex, everything in food. Mostly energy, because energy is in everything you buy. You buy bread and it's got some grain in it, but actually the cost of the diesel is probably a bigger component of the cost of the bread than the grain. So the Fed has decided and is telegraphing that it's going to raise rates. Now, by the time, the question is, when we get to the end of summer, right? I'm pretty sure that for various reasons that the Fed's going to be hawkish all the way through summer. They're going to talk hawkish because it's their job. And what we all hear, I'm sure you're hearing the same thing, because we all talk, read the same Fed speeches, if you will. Is that neutral is assumed to be somewhere like 2.5%, and that Eurodollars is pricing in something like 360, something like that. There's a spread of Eurodollars over the OIS, over That might be 25, 30 beeps. Who can say? It's a tricky thing to estimate. But there's a lot more priced into the Fed than neutral. And if you ask me why that was, I'd say it's because Russian capacity is excluded from global markets. If you're Indian, you can buy Russian capacity. If you're European, you can't. So all of a sudden, we're paying more than Indians for oil or for plastics or for fertilizers or whatever. That's a problem for our economy. A good thing for them, bad thing for us. And at the same time that's happening, we still have the wealth effects of what the Fed did during COVID. There are, a lot of people, if you're at the lower end of the income distribution, you probably are not experiencing any wealth effects whatsoever. If you're at the upper end, you own 15 multifamily buildings or something, you should be taking extra vacations because, boy, you just made a lot of money. So 80% of the population does 20% of the consumption. The other 20% are not going to notice what the Fed's doing. It will take a while before they even get the memo that their stocks are going down. So that makes me think that, they're going to keep hiking for the time being. And by the time you get shown to be correct, bonds could be a lot cheaper than they are now.
Well, they could be, except the Fed has no control over the long end of the curve. And that's what really starts to get interesting. I used to have a paper that actually acknowledges this by the Fed, and I lost it, and I've tried to find it. But some young member of, I think, the St. Louis Fed wrote a paper that said in the 1980s, mysteriously, the Fed lost control of the long end of the curve. Now, they said prior to that, the Fed could hike and everything would move lockstep. They said after that, another conundrum of the Fed not knowing anything about money or monetary policy, they couldn't figure it out. And so what starts to happen is the long end of the curve, as we now know, is more of a function of growth and inflation expectations. So you kind of mentioned the stock market. Well, that's really an interesting barometer of growth because you can take the year-over-year rate of change in the equity market against the year-over-year rate of change in, say, the 10-year Treasury. You notice there's something interesting there because if the market starts to go down, well, what happens is you see yields start to go down as well. And then all of a sudden, let's come back to Milton Friedman. What did he say? Well, falling interest rates are a sign where monetary policy is tight. Well, what happens to inflation, particularly when we know there's a 50 basis point hike coming in less than 2 weeks? I think you'll agree that's coming. Yep. We know quantitative tightening officially starts. And I think we both are largely expecting another 50 basis point hike the following month, and then probably another one in September, because the Fed's got to bring inflation from 8 to 2. People think, they're going to quit. You can understand 8 on a year-over-year rate of change on a lagging indicator is a big number. To get it down to 2, as you said, it's not going to happen overnight. I mean, really, if it did, that means the whole economy just blew up tomorrow. It's going to take the Fed a while, and they're going to front run this. But the problem is monetary policy works with a lag, at best 6 months, but you're looking at more of like around a year, possibly 18 months, this is going to kick in. So the Fed's going to overplay their hand in the long end of the curve. Now, the front end, I'll agree with you. Fed has total control over that, but the long end of the curve, which is, again, where I look to hedge my portfolio, says that, hey, if growth is coming down, market's coming down, then inflation starts to come down. Well, that's bullish for bonds. Doesn't matter what the front end of the curve is doing, because that's how we see curve inversions.
So it's really hard to argue with that. I think it's a very reasonable position to take. My natural inclination is to always see the glass as half empty. It's just a gift I have. I look at the current situation and I think, how could this blow up nastily? What could really go wrong? Because believe me, when I drop toast, it always lands butter side down. So the thing that strikes me as the thing that is something we should all be thinking about as a risk. Generally speaking, bonds and equities are inversely related. That's been true for 40 years. But if you go back 300 years, that was not true. 300 years ago, bonds and equities actually tended to have a positive correlation. And that's because inflation may have been, particularly when gold was the monetary instrument, the monetary base, governments didn't really have significant control over inflation until they discovered new deposits. Like you got inflation when they discovered gold in San Francisco, when they discovered gold in South Africa. Until then, money supply was a kind of exogenous variable. So if inflation was happening and they didn't like it, then they just tighten policy as much as they could, and vice versa. That if we go back for whatever reason temporarily to a situation where interest rates are not inversely related to the stock market, then oh boy, people can lose a lot of money, because that which is meant to be the hedge won't perform like a hedge. It'll only be a hedge in as far as bonds are less volatile than stocks. Otherwise, you've got no real hedge there.
Right, absolutely. Then there's no doubt. I mean, and I think that's what's interesting about portfolio hedging. Can you hedge with cash? Yes. Short-term treasuries? Yes. Long-term treasuries? Sure. Maybe crypto. I'm not an expert in that space. You look at, say, airbags. There are plenty of times you'll hear in the news that somebody got in an accident, the airbag went off, and they were worse off. That, somebody came in, some expert, and said, man, if that airbag wouldn't have gone off, maybe they would have lived, or maybe, boy, it wouldn't have messed them up. No hedge is perfect, right? And I know, because if it was, right, Harry, this would be a really boring chat. We'd be like, well, we should just hedge with this every time because it always works. And it doesn't matter. You just go with that. And that's what makes, what we do very interesting, is because they're highly educated bets that these hedges are going to play out. And so then the question is, well, okay, Steve, well, what if you're wrong and long-term bonds don't work? All right, well, then should I tack on some more? Should I add to my portfolio some Bitcoin, some gold, treasury, short-term, long-term cash? Well, at some point, 80% of my portfolio is now hedged, right? And I'm hedging 20%, and it doesn't make a lot of sense. And that's the real challenge, is as money managers and as people who are advising people on how to manage their portfolios, what we're trying to do is say, look, given the current constructs of the system, based on how we see it, this is your best bet. But could we have a recession? Could feasibly rates rise and it not work? Well, absolutely, that could happen.
So we can have a recession and inflation remains unpleasantly elevated. That's my sneaking suspicion about how this is going to play out. And boy, it's going to be very, very unpleasant, because, right now we've got no unemployment, which itself is a concern to me. I think to myself, where did all those workers go? It's like according to some estimates, there's about 3.5 million workers missing from the labor market relative to trend. And I got a sneaky suspicion. We did some work at MI2, which might suggest that it's because of COVID, that a whole bunch of workers left the labor force, and they may have left it permanently, partly because they're retired, partly because they're not that well in the first place, partly because they're staying sick. If that's true, the Fed will have its work cut out to bring inflation down. It will take a bigger tightening in financial conditions than you might reasonably have expected in the past. That's what bothers me about the whole situation. The other thing is, ever since the whole 401k thing came in, 401ks came in because we were living too long. People are living too long. So companies sensibly spotted that they had this liability on their balance sheet, which is your pension, that was turning into a bigger and bigger liability over time. So they appealed to the government, and we changed things, and we gave people the right to manage their own finances, just their pension provision themselves, and gave them tax advantaged savings vehicles. But that meant that everybody is now a CIO. Well, it's not an easy job, right? And some of these CIOs out there, you, a retail investor, you do not have direct access to CEOs of Fortune 500 companies. You haven't got a bunch of investment banks competing for your dollars. It's not a level playing field. So this whole situation strikes me as potentially disastrous if inflation were to be tougher to control than the consensus expectation.
100% agree, because what's the CPI, 8.3, and we'll get I don't know when this is going to air, but we might have the print before that. So we'll just say we don't know where it is. But let's just say, for example, it drops to 8.1 this week. Well, what's the Fed going to do? 50 basis point hike. Now, let's say next month before the meeting, it drops to 7.9, 50 basis point hike. Let's say it's September, it's down to 7.6. You're going to 50 basis point hike.
Absolutely.
The problem is the Fed's going to keep going until this thing comes down, and then you're going to get those lags. Those monetary lags are going to start kicking in, and once they kick in, then it's disastrous, because now all of a sudden you're bringing inflation down, and this just heavy-handed tightening is all going to start kicking in.
Yeah.
And what do you do now? The Fed's going to champion this and say, well, we got inflation under control. Yeah. And Powell's been championing his buddy Volcker. Well, you had a mild recession followed by a really nasty recession, and that was great. We crashed the markets. We crashed the economy. And all the people that quit their job because the market was up, which is where I do think a lot of people left, not to mention the boomers retiring, but now all of a sudden they're coming back to work because, their 401ks, as we kind of used to joke years ago, became a 201k. Well,
I haven't heard that. I missed that joke. What can I say?
Oh, you don't remember that? Yeah,
No.
but I don't remember what was during the great financial crisis or the dot-com bubble. People started calling it their 201k. So that's where I think people start flooding back to the workforce. And then there's all of a sudden now you have this surplus in labor coming back, which will drive wages back down. And all of a sudden, you're now kind of in the spiral the other direction. I think the bigger risk is the Fed goes so aggressive that we go from high inflation to practically de-inflation as they try to control it, knowing the Fed is just a poor manager of the monetary system.
Yeah, the scenario you're outlining is a potential depression scenario. It's true. This is, it takes a couple of steps to get there, but none of them are particularly weird. Higher than expected inflation, over-aggressive Fed leads to over-tightening, and then a recession is hard to get out of. The only thing is, wouldn't you assume, one of the lessons we learned in COVID is that fiscal policy really does work, maybe a little too well. Why didn't they just fire another fiscal bullet at it?
Well, that's now we're talking the political angle. I mean, it's interesting. You start looking back at periods of high inflation, and so what starts to happen? You mentioned kind of the little guy, the 80%. You could almost move it up to the 90% of the people. They own 10% of the equity market. They have no exposure virtually, so the market goes down by half. I mean, it doesn't change their life at all. But those people, their wages are not keeping up with inflation now. So they start to demand why. And now gas prices are really getting out of control. So if no one will solve their problem, what do? Well, they go to the ballot and they vote out who. It doesn't matter. Now, some people say, well, it's Democrat, Republican. It actually doesn't matter who. What matters is the people will vote them out of power. So we have the midterms coming up. I think the Democrats are well aware. We know Biden's really concerned about this because he effectively recently told Fed Chair Powell, hey, look, this is your problem. You created this. I can't do anything about it. And he's trying to tell him, hey, hint, hint, blame that guy when it doesn't work. It wasn't our problem. We didn't do any fiscal stimulus. We didn't do all this stuff. We had nothing to do with it because it becomes a blame game. And all of a sudden now, if you are a Republican, you want to be running on no more fiscal stimulus because look what those guys are the ones that really screwed you. If you're hurting, it's because of them. And so you start to see the shift from let's give everyone money to no, we're not going to give anybody money. And I think that's kind of what we've gone from one. I think what we're talking about now is extremes, right? Extreme inflation, extreme deflation, extreme fiscal to no fiscal. And I think that's where it's at right now is voters realize that it looked good at first. And now, look, they're paying even more. I mean, had they not gotten the money, they might have been better off today than they are now. And so I think that shift is coming. The midterms, we see Congress flip from Democrat to Republican. The Republicans historically are really good about, hey, we're not going to do any of that kind of spending. And now all of a sudden, Biden's spending the next couple of years in the White House, and he's not going to be able to do anything either because whatever he wants to do, they'll say no, no, no. And that's not good either.
Yeah, I'm totally with you. It seems to me that we will get some more additional fiscal in the form of defense spending, as guaranteed. And in fact, if I were projecting it, I'd assume we're going to double defense spending from where we currently are to, because we're back in 85. I remember looking this up, and back in 85, we had, I think, 6% of GDP on defense in the United States, and now it's closer to 3%. That, it seems to me, circumstances would suggest we should have defense spending on a par with the end of the Cold War, not on a par with the kind of end of history. If you see what I mean, we got a new Cold War starting here, so that's one thing. And it may be the case that's all the fiscal we can get. In the circumstances, that isn't going to get deprioritized. So I'm worried. I mean, I look at it. We mentioned diesel, we mentioned food. Natural gas, I don't see any relief from these. Natural gas prices are almost triple what they were 2 years ago. But natural gas is in everything. And I'm particularly galled because I've kind of converted all of my living circumstances to run on natural gas. And now this has happened. Why did I spend all that money? So anyway, those are the reasons I'm particularly worried. But all you've done is that reinforce the problem. I got a bunch of cash. I've got way too much cash, in fact, relative to my portfolio size. What the hell? Where do I put it? What should I be investing in?
Right, and that's what separates, as professionals, whether we're money managers directly or advising money managers, is if you get that call right, bam, you go through the recession, you don't take the big hit. Your clients are just singing your praise to everybody, right? Because all their friends go the 401 to the 201, and they're telling, hey, look, my guy, my gal, boy, my firm, boy, they just crushed it. And then you're turning around, selling off your hedge, and next thing you know, assets are pouring in, and for the next 10 years, you're just king. You're just I won that. And that's really what it comes down to. You get the hedge wrong, you could just be as worse off as everybody and say, well, the market went down 50%, our hedge went down 30. Well, that didn't work out at all. We got clobbered. And that's what makes what we do so interesting is all the research and not just current research, historical research. I know MI2, you do a lot of that there is, what is the high probability bet to do with this cash to come out a winner, to lose less during the most likely outcome of a Fed-led recession and bear market. Again, as people shake their heads, losing less is a winning? Absolutely, it's winning. Because think about this, right? Well, how the S&P was down in the great financial crisis over 50%. If you only were down, say, 10 or 15% at that same bottoming level, you won.
Yeah. It's true.
Because you come out of that and you're in the green.
And also there are so many, when you get out the other side of a big market event, something catastrophically bad, there's a lot of cheap things to buy. There's a lot of cheap, and those things will double, triple, even quadruple on you. So if you can stay roughly intact, the opportunity set is beautiful. It's just easier said than done, right? It's not so easy to keep your fur out of the fire.
One thing I like to tell people is wealth is created in bear markets.
Opportunities are created in bear markets.
If you think about it, the hardest thing for an investor or a money manager is to be opposite what the trend is. Because if you can break the cycle once, if you can get to the point where instead of buying your house at the peak of the market, you sell it and maybe buy at the bottom, you can change your financial future. You could do the same with the equity market or anything else. But if you could do that 2 times in your life, which is maybe the best you'll have, because you think about, well, when you're 20 years old, you don't have any money. So it doesn't matter if you time the markets right. You didn't take $1 million and turn it into 3.
Yeah,
or
triple nothing is still pretty close to nothing, right?
Right. And that's what I try to encourage people is like, look, if you missed out on the cycle, it's okay. Just don't get slaughtered in this bear market, because when things are cheap, I mean, Harry, you and I might come back on and say, what should you buy? Buy everything. It doesn't matter. It's all on sale. It's all a good deal. You can't lose. Sure, some of them will be better than others, but hey, you're probably at worst going to double or triple your money. So go and buy everything.
Yeah, it's true. I'm so old. I had an acquaintance who his family managed to buy a lot of land in Aspen. I believe they bought 80 acres of land in Aspen in the savings and loan bust. It's either 80 or 800 acres. You get to my age, your memory isn't what it used to be. So, and I think they paid probably 80 acres, and I think they paid $500,000 for the 80 acres at the time. And he was telling me this. He's a very well-off guy and works for this bank which has a G and an S in its. He's a senior guy for that. He told me that his family and this is back 10 years ago, his family was selling off half-acre parcels for $500,000, the same price they paid for the 80 acres. So yeah, but that's an extreme example of this phenomena.
But it's a good one, because I think you just illustrated the whole point of where we started this conversation is what really is a portfolio hedge. And you just mentioned, hey, this guy had cash. And what a portfolio hedge is something you can readily convert to cash because it's appreciated, that everybody wants. And so what might that be? Could it be cash? Well, cash is already cash. Could it be bonds? Could it be gold? Could it be Bitcoin? I don't know. Exactly. My bet is a bond market, but it could be something different. The key is what you want to have at the bottom of the recession is what everybody wants, so you can sell it and go buy what everybody is selling.
Just so hard to identify the robust asset. And cash is the easiest of those things to identify. This is going to retain some of its value. Right now, cash is losing value at 8% a year. There's a fair number of my friends who are saying to me, it's about as good as you can expect. That's about as good as it can be. To my mind, this is one of the trickiest investment environments I've seen. And outside of the big caps, there's a lot of cheap stock out there. If you like equity, and I'm a terrible equity investor, absolutely terrible. If you like equity, it seems that there's a decent number of cheap stocks out there. I'm an emerging credit guy. So I only trade once every blow up. And I buy emerging market credit when something bad has happened, like a default or right now I'm blocked to buying what I would normally try and buy, which is something like Russian debt. That's the kind of thing that 30 cents on the dollar, I'll do some of that.
Right, because you're downside risk, right? I'm not losing a dollar, I'm losing 30 cents. I can afford to lose a little bit, right?
Exactly. Once again, another example of how old I am. Back in 98, I was working in Russia when the Russia crisis happened. And a friend of mine told me a story about a bond salesman at Lehman Brothers. This guy had a $5 million bonus and he put it all into Russian Eurobonds when they're trading at 20 cents on the dollar. 20 cents on the dollar meant that each coupon was about 50% of his investment because they were paying about 10% coupons. So he ended up making pretty much, he made $20 million out of the $5 million bonus. And that was within 3 or 4 years because each coupon paid him $2.5 million. If you see what I mean. Now, of course, those Eurobonds are probably back down to whatever price they were originally, but he got a lot of coupons. So yeah, I do think one of the things that protects you the most in a bad market is price. If you buy your asset cheap, then you have a great chance of being robust through the market event. If you're paying top dollar for the asset, you better have fundamental value.
Yeah, and that's what's great about portfolio hedging, because we started with this whole notion that if you hedge, you're going to have a drag on returns. But if you're all in on the major industries and they crash, you have nothing. You have no opportunity cost. And that's the challenge for a lot of investors is they're literally looking at their return and saying, well, I'm beating so-and-so and I'm beating everybody. Well, yeah, but market cycles happen as they always do, you're going to go from outperformance you're going to outperform on the way down, which is even worse. You're going to lose more. Meanwhile, the guy that's sitting on 20% hedge, maybe just in cash, now has that cash to deploy. Instead of just making 100% return on that cash, they might actually make 2, 3, who knows? Whereas the person who was 100% in the major indice is going to eat the loss and then pray that the thing goes back up. That's the beauty of it.
Yeah, no, I totally agree. Portfolio construction is a great thing if you get it right. If you get it right, you have a combination of the diversification working for you, but also people who can do this well, they get luckier. I've noticed this over the years. If you've picked a portfolio which is robust to a particular scenario, it's amazing how lucky you will end up. Stuff will happen, like the Fed will call its dogs off a little earlier than you expected, and all of a sudden your strips or your 30-year long bonds will add 30% very quickly. That's because you bought them cheap enough and you bought them close enough to fundamental value that you had that convexity working for you. It's difficult though because nobody's got that crystal ball. So what else are you looking at right now? What else has got share of mind of you, Steve?
Well, when I think about the disinflation, deflation story, I want to come back to the 70s because there's another aspect that was going on then that we're seeing different now is the dollar, had been the reserve currency for a while, but I like to suggest to people that the world really didn't know, and we in the United States, we didn't know what to do with the thing either. I mean, you go back to Bretton Woods and the fact that they, put this together in the short time they did, I think they were trying to solve problems and they really didn't know where this would go. And you start to understand, as the world's reserve currency, the United States' role is to export dollars, export inflation. And in the 70s, when I was born in the mid 70s and early 80s, I remember that foreign produced goods and services, well, maybe not, I don't know about services, but I remember goods in particular, vehicles and toys they're referred to as junk. And people didn't want them. I'm like, oh, the neighbor bought a European sedan. Well, they're going to be fixing it all the time because all it does is break. Haha, what a fool. Today, that same European sedan, oh, wow, they must be very successful to afford the pinnacle of the luxury automotive vehicle. It was a whole different world because the US was such a manufacturing powerhouse relative to the rest of the world. We didn't have anywhere to export our dollars to, because if you wanted to buy something, you were better off buying an American made good than you were buying a foreign good. Well, that all changed as US corporations figured out they could outsource their factories to lower cost labor, and then over time figured out that low cost labor could actually produce really good stuff, whereas initially it was still very questionable. So you look now at the deflation story is you see a lot of imports flooding into the US because now these foreign producers can compete against US producers. So when US prices go high, all these foreign producers are like, man, I can make a ton of money. I just need to get my widgets over to the US as fast as possible because my cost of production is less. And while they're dealing with unionization, healthcare, wage increases, all this stuff that they will know can't come down, we can undercut them. And that ultimately leads to disinflation. It eventually leads to unemployment in the US as domestic factories and producers just can't compete. So they have to go to more higher automation, lay off employees. And then what do you start to see? A buildup of inventories, and you start to see a buildup of low cost inventory. And ultimately, next thing you know, wholesalers are discounting, retailers are discounting because they got to get rid of that inventory. Meanwhile, those foreign producers are just cranking this out. Hey, as long as that CPI is running hot, boy, we need to get over there. And I think that's a story that's missed out today, that people think, well, prices are going to continue rising. Well, we just saw during earnings, Target, Walmart, other retailers, now they have too much inventory and they're going to have to start discounting to clear it out. Meanwhile, imports are still running the US at really strong levels because this global economy is working the way it should. We're exporting dollars to foreign countries and they're coming back as cheaper goods. And ultimately, that's why another reason we can't see persistent inflation here in the US.
This is true. The crisis in a number of countries in the world has resulted in massive dollar appreciation. And it's not even obvious to me that the thing stopped yet. The supply chain issues so I looked at the Walmart and the Target results, and I was quite struck by them. Struck because my suspicion is it's not the amount of inventory, but the inability to control the timing of inventory, which is the problem. And it's no good for Walmart getting a whole bunch of swimming trunks in at the end of August. It's no good getting your Halloween gear around Christmas. It doesn't work. It's really important when the stuff arrives because they don't carry as much inventory. The ships used to be the inventory, and if China shuts down, stuff doesn't arrive on time. And I have the sneaking suspicion that even if on aggregate everything looks fine for the US economy, the profitability of US corporations might have been dramatically impaired by the supply chain problems, which would then give you a totally different relationship of the fair value for the S&P versus where bond yields are. So, and I don't know that for sure. But as I said, that's my sneaking suspicion. That's what's going on, and it's gonna happen to a lot of companies because a lot of stuff comes from China now. A lot of stuff.
Yeah, and then with China starting to reopen now, we can only imagine that there are ships. Well, we know there are ships. We could see the shipping. They're piled up at the ports. They're waiting to get loaded and come over here and dump even more inventory. Because again, you have this arbitrage where there's high prices in the US where US producers can't lower them, can't compete, and we have low cost labor. We can undercut them. And so we're going to grab market share. And then next thing you know, the consumer has negative inflation adjusted wages, so they can't afford all this stuff. And next thing you know, you get now attacking on all the other issues. You have an inventory recession where all of a sudden there's cutting because, hey, like you said, we've got the swim trunks at the wrong time. We need to get the back to school stuff. Well, we don't have room for it because the warehouse is full. Well, you got to clear that stuff out so we can get that stuff in, hopefully on time. And if we don't get that on time, now we're really screwed, because now we're going to be in Christmas with back to school stuff. And boy, we got a big mess for months to go.
Yeah, absolutely. The problem is we've got a capacity to handle shipping that's appropriate for when everything's working smoothly. When you got a big backlog, we don't have the capacity to handle that. And of course, that's great in good times, because you minimize the application of capital for the business. So your return on equity is enormous. And then when you go into bad times and nothing works, you have negative return on equity everywhere you look. So this is, anyway, as I said, my glass is always half empty. Anyone sensible listening to me, you need to visit your doctor and get some sedatives or something, because I'm a pretty negative guy. But when I look at this, I don't think this is an easy investing environment. To me, everyone's been trained by what were perfect markets since 2009, right? It's basically get long and get long carry. It always worked. Everything worked. And I suspect everything will fail. The next 2 years, the market's going to be really tough. And to me, the biggest argument for bonds is they have about a quarter the vol of equities. So even if they're trash, even if the Fed yanks rates on you, you're going to lose a lot less money in that instrument than you will if you had certain heavily levered, cyclical or growth stocks. Some of that stuff's very expensive on a bigger picture basis. And I say that, God knows I'm wrong a lot. So anyway, if people manage to get to the end of this conversation, well done. You got more stamina than many. Steve, it's been a pleasure. Talk us out. What should be what's the takeaway from this talk? What should people take away?
Yeah, I think the takeaway is that people really should hedge their risk. Whatever it is they're doing, they should hedge their risk, because they need to understand that bear markets are opportunities. You might not get it right, but if you do, the opportunity, as you mentioned, Harry, is to buy stuff, whether there's real estate, whether there's stocks, whether there's gold. It doesn't, whatever your flavor is, there's going to be bargains out there. And we've all met that person, who for whatever reason needed money and would say, man, if I could sell my car or my ring or whatever my collectible is right now, because I need money so bad, I'll take any price. That's what happens at the bottom of bear markets, is people need cash so bad, they're willing to unload really good assets at super discounted prices. And you want to be the one that's buying them. And the only way you can do that is if you either have cash or have something that can convert to cash because it went up in value. And then you can buy those assets cheap, and then you can ride the next wave for however long that may be. But I'll bet you it'll be a really good one.
Hey, quite often it isn't even people. It's the bank that repossess the asset from people. Well, they don't care what they get for it. Totally. Steve, it's been a pleasure. We've got to do it again sometime.
Harry, I had a great time. I'm absolutely looking forward to the next time.
Have a good one, mate. Speak to you soon.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.